Hello, my name is James Harwood, Portfolio Manager of Russell Investments' two equity ETFs, RDV and RARI. The purpose of today's update is twofold. First, I'll provide an update on the recent changes made at the recent semi-annual reconstitution of the two ETFs in April. And second, I'll provide investors with an update on Australian shares in 2019 and our outlook for Australian shares going forward. Now, before turning to the two index changes, I'll first touch on Australian shares in 2019. Now, the bounce back in the share market has been quite dramatic following the sharp sell-off we saw in Q4. Up until the general election, the theme that we saw in Australian shares was really very similar to what we've seen for the last couple of years, and that was both growth and momentum stocks outperforming and driving the market higher. However, investors are increasingly questioning the earnings multiples that a lot of these growth stocks are trading on. And indeed, an AFR article at the end of May that cited some work done by Goldman Sachs suggested that Australian growth stocks are some of the most expensive in the world. Now, the general election result from a share market perspective saw investors breathe a sigh of relief. The big four banks benefited, but so did a lot of cyclical stocks, as the outlook for the Australian economy was deemed to be better with the coalition government. A number of sectors like retail and construction have all bounced well very since, and those stocks had become really out of favour. And this has seen both RDV and RARI outperform year to date. In 2019, we've seen a number of companies pay special dividends, companies like Fortescue Metals. There have been several off-market share buybacks, the most notable being BHP. And it does seem that yield stocks are now well placed going forward after a period of relative underperformance. Indeed, RDV in this current financial year is expected to pay a net dividend yield, and that's before franking credits, of around 6.5%. And that's helped by participating in the BHP off-market share buyback. Now, turning to the recent reconstitution, you can see on this chart some of the key sector changes that were implemented on 1 April. There was a sell in financials. However, RDV remains overweight to the financial sector versus the ASX 200. Most financial stocks pay good levels of yield and fully franked dividends, and consequently RDV has an overweight position versus the broad market. Also, at the reconstitution, there was a large net buy of consumer discretionary stocks, with a number of companies in that sector offering really quite attractive dividend yields following that period of underperformance when they had become out of favour. From a stock-specific perspective, JB Hi-Fi was the most notable of these, and that has really been a big beneficiary since being added into RDV's portfolio. And had a further jump in performance following the election. Bank of Queensland was a total sell for RDV, and that was because of its diminished dividend growth outlook going forward, and that's a key part of the RDV's index construction methodology. Construction stocks Boral and Adelaide Brighton were both saw weight increases of around 1.3%, and Dulux Group was a new add. That proved to be very good timing because in mid-April, Dulux Group received a takeover offer from Nippon Paints of Japan, and that deal looks set to go through in the next few weeks. And before the end of the financial year, Dulux Group will pay around a 3% special dividend, and that'll be paid out at the next distribution for RDV. Lastly, utilities were a net sell at this reconstitution, and that really continued a theme that we saw at the last reconstitution back in October 2018. Turning to RARI, now this slide really shows how RARI's index construction methodology is implemented. We start on the left-hand side with the FTSE ASFA 300 universe. From that universe, the Responsible Investment Committee then apply a series of widely held ES&G exclusions, and are excluding companies like tobacco stocks or those with exposure to alcohol. And most recently, at the most recent reconstitution, the committee also excluded or made a more stringent exclusion to fossil fuel. The committee deemed that an ESG ETF needed to have a lower exposure to energy, and we applied that by adding a fossil fuel reserves exclusion. Fossil fuel reserves are essentially oil, coal, and gas assets that are still in the ground, and any companies that have some of those assets on their balance sheet are now excluded from the RARI universe. And that saw 5 stocks being sold at the most recent reconstitution. Once all of the ES&G exclusions are applied to that 300 stock universe, we then apply 2 positive tilts. We tilt to ESG scores from Sustainalytics, and then we also used a yield tilt, and that's using the composite yield score, which is the same methodology as what we use for RDV. The end result is a 67 stock portfolio, and that's the number of stocks that are currently making up the RARI ETF. You can see from this chart some of the sector changes that were implemented back in April. Clearly the largest was a net sell to the energy sector, and that reflects the fossil fuel reserves exclusions that was added at the reconstitution. And on the positive side, a lot of that, those energy assets were reinvested into the financial sector, and they were also invested into the consumer discretionary sector, really following a lot of similar themes to what we saw with RDV. For the financials, the largest add or the largest new buy was Platinum Asset Management. That was a 90 basis point add for RARI, driven by its yield credentials. Stocks JB Hi-Fi, Boral, and Dulux Group saw weight increases or were new adds, just like RDV were. And on the flip side, CSL was the key driver behind the weight reduction to the healthcare sector. Finally, RARI remains overweight to the REIT sector. It has about an 8% overweight versus the ASX 200. This has served RARI very well because REITs have essentially outperformed for some time now. And this has been driven by the fall in the 10-year bond yield as interest rate expectations have come down a lot. The 10-year bond yield now sits at around 1.5%, having started the year at 2.3%. And this has really helped benefit RARI's performance versus the broader market. Finally, turning to Australian equities going forward, the market no longer looks cheap with it being back above 6,000. We're trading on forward earnings of around 16 times, and then the net dividend yield has slipped to around 4.5%. That said, rate cuts are likely to remain supportive for equities. The recent rate cut from the RBA is certainly helpful, and now even the Federal Reserve is talking about the next rate move might be down rather than up. And that's really quite a marked change from the start of the year, driven by ongoing fears of the China-US trade war. It does feel that it's a good time for dividend stocks. They've had an extended period of underperformance, but a lot of dynamics now appear favourable for dividend stocks going forward. RDV and RARI both offer good exposure to this. They both have positive tilts to yield. And they're now offering around 4% yield in excess of the RBA cash rate, which is 1.25%. So the share market can stand still, but investors are going to be much better off staying in RDV and RARI, so long as equities remain flat. I hope you found this update useful. Thank you for listening.